Welcome to The Explainer. Today, we're diving into a fascinating story about how one specific B2B software company is quietly powering the massive global AI hardware boom. When we talk about the AI revolution, we usually think of consumer apps, chatbots, or the giant hardware manufacturers. But beneath all of that lies this incredible architectural layer. We're going to explore a company that is essentially the silent architect of the entire semiconductor industry. Here's our roadmap for today. We're going to cover the AI hardware boom, meet the folks at Cadence Design Systems, dig into their massive Q1 2026 earnings, look at how they're expanding their moat, check out the risks to watch, and wrap up with the big takeaway for investors.
All right, part one, the AI hardware boom.
So here's a question for you. Who's actually building the tools for the AI era? I mean, we all know the heavy hitters, like NVIDIA or pushing out these massive open ecosystems and powerful language models. But who builds the wild, incredibly complex infrastructure that lets those chips even exist in the first place? Because long before a physical silicon wafer is ever printed, the whole thing has to be designed, simulated, and totally perfected in a digital space. This really captures the big macro trend we're seeing in 2026. AI is quite literally jumping out of our web browsers and into the physical world. We're talking autonomous vehicles, robotics, advanced physical reasoning. And taking AI into the physical world, that requires a completely new magnitude of computing power. It's driving this just insatiable demand for flawlessly engineered semiconductors. When a chip is driving a car, the margin for error is absolutely zero. Which brings us to Section 2, Meet Cadence Design Systems. You know the old saying, right? In a gold rush, the folks making the real money are the ones selling the picks and shovels. Well, Cadence isn't building consumer AI apps. They aren't selling the gold. They are the ultimate software architects behind the scenes, giving the world's tech giants the tools to design the chips themselves. Like their CEO, Anirudh Devgan, recently pointed out, they're seeing incredibly strong customer demand for their AI-driven product portfolio. They're perfectly positioned to just scoop up the massive opportunities this era is creating.
So what's actually in their toolbox? They operate in a space called electronic design automation, or EDA, and system design. Basically, they provide the absolute mission-critical software for things like data center capacity planning, power and cooling optimization, and this really amazing digital twin technology. A digital twin is exactly what it sounds like, a flawless, highly detailed virtual simulation of a physical chip. It lets engineers run extreme infrastructure scenario modeling. Without this EDA software, those advanced chips powering the latest AI models literally couldn't be engineered.
Okay, let's look at the hard data in Section 3, Smashing Q1 2026 Earnings. The sheer scale of this growth is honestly staggering. Take a look at this. $1.474 billion. That's their Q1 2026 revenue alone, representing a massive 19% jump year over year. And the best part? It wasn't just one lucky segment doing all the heavy lifting. Every single one of their business segments hit double-digit growth. That is a massive, clear signal showing robust, across-the-board demand for their software. But hey, past revenue is just looking in the rearview mirror, right? What really matters is what's coming next. And honestly, this is even more impressive than their quarterly revenue. They are sitting on a record $8 billion customer backlog. That is $8 billion just waiting in the wings. For the management team, that kind of backlog provides unbelievable revenue visibility, which is exactly why they're so comfortable guiding full-year 2026 revenues to well over $6.1 billion. Let's translate some of this financial jargon, because this is where the real magic happens. Earning a lot of revenue is great, but it doesn't mean much if you aren't turning a profit. If we look at their non-GAAP operating margin of 44.7%, which strips out the one-time accounting noise so we can see the real operational health, it's clear they have best-in-class efficiency. It's absolute proof of Cadence's massive software pricing power. They brought in $1.96 in non-GAAP EPS this quarter, meaning as they scale up, a massive chunk of that money is dropping straight to the bottom line. Moving on to Section 4, Expanding the Moat. Now, a business this profitable is naturally going to attract fierce competition. So how does Cadence protect its turf? Through immense cash generation. Check out this timeline of their free cash flow over the last 5 quarters. It's just serious, consistent cash generation. Quarter after quarter, in Q1 2026 alone, they pulled in over $300 million in free cash flow, and they're projecting nearly $2 billion in operating cash flow for the entire year. This isn't just a paper profit. This is real, hard cash entering the business, and they're planning to use about 50% of it just to buy back their own shares. All that cash gives them the ultimate financial superpower, flexibility. It actually earned them a highly coveted A rating with a stable outlook from Fitch. And why should you care about a credit rating? Well, it means they have the capacity to fund a really aggressive, strategic M&A strategy. They can essentially swoop in, buy up smaller, innovative competitors, constantly upgrade their tech capabilities, and expand into new markets, all without wrecking their credit or taking on dangerous levels of debt. But of course, we need to be realistic. Section 5, risks to watch. To be truly disciplined analysts, we can't just stare at the rosy numbers, right? We have to weigh these secular growth themes against some very real threats. Over on the left, the catalysts are undeniable. Booming AI product demand, the huge shift toward automotive electrification, and, of course, that massive $8 billion backlog. But on the right, the risks are glaring. The semiconductor industry, it's notoriously cyclical. If there's a broader economic downturn, R&D budgets globally could get slashed. Plus, swallowing up all those acquired companies brings serious execution risks. And, like basically every global tech firm right now, they are facing unpredictable geopolitical headwinds, particularly regarding their exposure to the Chinese market.
Let's bring it all together. Section 6, the investor takeaway.
So, how do we actually synthesize all this data? Well, it really depends on your own strategy. If you're a growth-oriented investor, you might look at Cadence and think, yeah, that premium valuation is totally justified by their absolute technological leadership and their central role in the AI and auto boom. But if you lean more value-conscious, current valuations might limit your near-term upside. You might need to sit tight and wait for a broader market correction to find that comfortable margin of safety. And if you're risk-averse, you definitely need to keep a close eye on those geopolitical exposures and make sure the rest of your portfolio is adequately diversified. I'm going to leave you with this final provocative thought to ponder as the global tech landscape keeps shifting. With AI scaling relentlessly into the physical world of robotics and smart vehicles, constantly pushing the boundaries of what microchips can do, will Cadence maintain its powerful iron grip on the picks and shovels of this boom? Or will some new, hungry innovator come along and disrupt the architects themselves? Keep a close watch on those margin trends and backlog numbers in the quarters ahead. Thanks so much for joining me for this explainer.